Hello. Welcome to In 180 Seconds. Today we will discuss an option strategy that I personally term as the strongest. It gives low profits, high return on investments and reduces risk. Wondering why we are trying to learn an option strategy that gives low profits? Well, I only meant low profits on the numbers. But the return on investment is high. What does this mean? In simple terms, think of these two scenarios. Let's assume I took rupees 5,000 from you today. Then add 2,000 more and give you 7,000 next month on the same day. Your profit is rupees 2,000. But return of investment is 40%. Now assume I took 2,000 from you today. Then add 1,000 more and give you 3,000 next month. Your profit is only rupees 1,000. But your return of investment is 50%. Although the profit amount is less, the return on investment is 10% more. Well, we are going to look at an option strategy that gives higher return of investment by providing lower capital or margin to the broker. So what is that strategy? It is called the IronCondor. This is how an IronCondor setup works. It has 4 steps in it. First, you need to sell a near OTM call option. Second, sell a near OTM put option. Third, buy a far OTM call option. Finally, buy a far OTM put option. To learn what OTM options are, check the link in the description. Now let us see this with an example. Today the Nifty is trading at 15,000. Let us assume these are the option premiums that the market is currently trading at. Step 1 is to choose a near OTM call option and sell. That would be selling 15,100 call option at rupees 100. Step 2 is to choose a near OTM put option and sell. That would be selling 14,900 put option at rupees 90. With this you pocketed rupees 190 in option premiums. The maximum profit would be rupees 190, if the range stays within 14,900 and 15,100. You would still end up with no loss if the market stays within the range of 14,710 to 15,290. Basically what you did up until now is short strangle. However, the total margin that you would need to provide would be close to 1.5 lakhs. So the return on investment is 9.5%. Can we reduce this margin money? You will know by the end of the video. Suppose if there is an unexpected event that triggers the market to either shoot up or crash down, then your losses would be unlimited with the short strangle. In order to arrest the loss from going out of control, we set up the IronCondor by doing the remaining 2 steps. Step 3 is to buy a far OTM call option. That would be buying 15,300 at a premium of 40 rupees. Step 4 is to buy a far OTM put option, which would be buying 14,700 at a premium of 30 rupees. As soon as you buy these far OTM call and put options, the margin that you need to show your broker or exchange reduces drastically to say 40,000. This is what brings you higher return of investment. Of course, the total maximum profit you would get would reduce by 190 minus 70, which is equal to 120. So the return of investment is 22.5%. At the same time, your risk is also covered if the market shoots up or crashes. The far OTM call or put option will come to rescue and protect your account. I hope this video helped you understand the IronCondor strategy. Don't forget to check the links in the description for other useful videos. Thanks for watching. Goodbye.